So where were we last class? We were just finishing up all of our adjusting entries, right? And we talked about, you know, you have to make accruals, you have to make adjusting entries for deferrals, and then the issue is, what do you do after that? Okay, and if you go back to the accounting process, it would say, okay, well now you need to make a post-adjusting trial balance, and then what would we do after that? What do you do after you've made your adjustments? You want to make your financial statements and closing entries, right? Okay, so we're going to do that now, and then we'll finish up the accounting. You want to stay? Oh, okay. This is okay. So where were we? Okay, so we were. What I did was I just separated our T accounts into permanent and temporary. Okay, what is a permanent account? Yeah. Okay, so why, even though we called revenues and expenses owner's equity, why are they not permanent? What's different about them? Okay, so you know whenever we wrote a journal entry, we would say, put in parentheses whether it was an asset or a liability or owner's equity, and when we would write an expense, we would put in parentheses OE or a revenue OE, and yet the answer was, to some extent, that what makes something permanent is that it's an asset or liability or an owner's equity. So if I've called revenues and expenses owner's equity, then what differentiates temporary accounts from permanent accounts? Yeah. Okay. So, and where do temporary accounts typically show up? So temporary accounts are income statement accounts. Permanent accounts are balance sheet accounts. Okay. So balance sheet accounts that will linger from year to year versus accounts that we close and that specifically go to the income statement. So while it's true, assets and liabilities and owner's equity is sort of a way of thinking about it, revenues and expenses are also sort of a component of owner's equity, but they don't count as permanent accounts, even though we classify them as owner's equity, because they get closed out and they are part of the income statement. Okay, so here are the permanent accounts, which are the owner's equity accounts. I mean the assets, so cash, accounts receivable. We have the contra assets, allowance for doubtful accounts. We have supplies, prepaid insurance, property, plant, and equipment. And then we have our liabilities, accounts payable, unearned revenue, notes payable, interest payable, salaries payable, common stock. Okay? And then we also have our temporary accounts. And these are the ones that we're going to close. What does it mean to close an account? Zero it out. What does that mean? I'm going to make you explain that further. Use revenue as an example. What does it mean to zero it out? Okay, so when you're telling me zero it out, you're saying I want the balance in revenue to be zero. How do you make that happen? Well, if you have a current credit balance of $106,000, what is the only way you can get from 106 credit to zero? Yeah. Okay, so we need to put 106 on this side. Okay, so we're going to debit revenue by 106,000. Now, you told me where to put what the other entry should be. What was it? Okay, what kind of account is income summary? It's also a temporary account. So why am I wasting my time putting something from one temporary account into another temporary account if I'm just going to have to close it again? Just hold it? Is that what you said? No, that's a good answer. We're just storing it there for a minute, okay? Could you close it out directly to retained earnings? Sure, you could. Why don't we do that? Because income summary is going to be a double check to make sure that our income statement is correct. Okay? We're going to put all of the revenue and expense accounts on our income statement, and our net income should be the same as our income summary. So we're sort of serving two purposes, which is just kind of making sure we're doing everything right here. So let's create this nice income summary account, which is now, what kind of balance would we like income summary to have at the end of our closing process? Okay, what does positive mean? Which side? Okay, having a credit balance. Why? What does that mean? Profit. Why? Because revenues, so these are owner's equity accounts. So the bigger they are, the more revenues we have, the bigger the credits, or the more credits we have. So if we end up with a credit balance, it means we had more revenues than expenses. If we end up with a debit balance, is it possible? Yeah, it is, unfortunately. That just means that we didn't make enough money to cover all of the costs that we had incurred this year. Okay, it happens. It's not desirable, but of course it happens. So what do we do? How do I close out rent expense? Okay, so because this has a debit balance, I need to put income summary and rent expense. Okay. Now, of course, now I can't use my clickers. We're not going to use the clickers until, I'll give you a little while for the clickers going on. Okay, so revenues get closed out to income summary, and expenses get closed out to income summary. We need to close all of these accounts. Okay, not just the ones. Now, should you write journal entries? Yes, you should. Should you then post them? Yes, you should. That's sort of you can't just do one thing or the other. Now, of course, in class, we're going to take a bit of a shortcut and just close all of these out more simply without actually going through the process of writing the journal entry. But you can combine the journal entries. That is, you can have all of the different expenses and then one income summary, or you can do them individually. Any of those choices are fine. But, whoops, hold on. Wait on dividends. Okay. So, 400, 1,500, 1,600, 15,000, 1,500, 500, 5,000. You're right. Thank you. Okay, now, why did I not do anything with dividends? What am I waiting for? Okay, is dividends, or are dividends a component of income? No. Income is how much did the company earn this year? Dividends is what did they decide to do with the money that they earned? Okay, so dividends is after you've earned it, maybe you decide to give some back or not. Okay, so dividends comes after the income process. So this is basically a short version of our income statement. Okay, and all of the information here is going to show up on our income statement. What do we do then? Close income summary to where? Retained earnings, because retained earnings is a component of owner's equity that is permanent. So we want to clear out all of those. So now all of our revenue and expense accounts are zero, but our income summary account also needs to be zero. What if we didn't zero it out? What would happen the following year? Then we would basically be reporting income summary twice. Okay, and we would have to then have a line item in our balance sheet for income summary. But have you ever seen a balance sheet where in the owner's equity section it says income summary? No, because that is combined or entered into retained earnings, because retained earnings is just what you've earned in the company up until this point, plus what you've earned this year, minus any dividends that you pay out. Okay, so here's your income summary. We're going to close that out. So now, why am I making income summary? Why am I making income summary a debit and retained earnings a credit? Because do I have a debit balance in income summary? I have a credit balance, right? Which is good, which means I earned more than I expended. How much more? You have to go back and look it up. I don't remember what it was, like 287,290, so something like that. Okay, so I'm going to close this out to income summary, and then I'm going to close out dividends. So I can write retained earnings. Now, why was dividends a debit balance to start out with, and why do I need to credit it now? So what is retained earnings telling you? It's telling you, here's how much the company has earned and kept within the firm. If I give some of the money back, have I kept it? No, so I have to reflect the fact that what I keep in the firm is actually going down. What happens when an owner's equity account goes down? What do we do? Do we debit it or do we credit it? Okay, so to reflect the fact that retained earnings is going down, we debit it. Okay, so that's it for the accounting process. Now, since the clickers, I haven't set up the clickers just perfectly yet. Would anyone like me to repeat any part of the mechanics? Since all this is sort of review, but for some of you it might have been a while ago when you took this class. Sure. Okay. So remember, I'm going to put the answers on Blackboard, so if you don't grab it all right now, it's fine. Any specific questions about where we got these numbers from? Remember, we've been working on this problem for a while, so it's getting stuck in our head. It's the total, right? So this journal entry is just the effect of closing out rent expense. I would also have income summary and depreciation expense and income. Now, and as if you prefer, you can have income summary just once, rent expense, depreciation. You can do it that way too. That's perfectly fine. This was just an illustration of one at a time. Typically, it's actually a lot easier to just have simple journal entries, which are one debit, one credit. And since there's no kind of cost, other than if you're writing it out by hand, it's mechanically annoying. But if your accounting information system is doing it, who cares? Right? It doesn't matter whether you have simple journal entries or complex ones. Okay, other questions? All right. So now we're going to shift gears, and so what you should know by now and remember and have remembered from the first class or the first course is okay. So I want to get rid of this one. Is just the mechanics of accounting, but ultimately, if you remember in the first class, I said, if it were just so easy and it's all mechanical, you could have stopped at the first accounting class and pretty much been done, and you wouldn't actually need to continue learning more about about the underlying theory of accounting. And so what we're going to do today is we're going to try to explain or provide some overview of what drives accounting rules. Okay, so if you think about the legal system, right? We're constantly making new laws. What are those laws based on? Like, or if a law gets overthrown or overturned, what are they basing that decision on? On, what'd you say? Okay, so you create a law in response to the fact that people don't know how to deal with something, right? So people are going and killing each other, and we say, you know what, that's probably not a good idea, so we're going to outlaw that. Okay? You might not have been aware that that wasn't a good idea. Now we're going to let you know. Why? What is driving our decision that that's not a good idea? Why don't we just let people kill each other? I can't believe this is being recorded. Okay, why? So why don't we do that in general? What is the overriding principle of the land that says we shouldn't do that? Okay, but what do we have anything that codifies or declare? Like, so in some countries they may feel that one sort of behavior is appropriate, in other countries they don't. What decides that? Okay, but what if one government thinks protecting people means forcing everyone to behave exactly the same, and another government thinks that it means letting everyone have individual freedoms? What's telling you what? Okay, well, what do we have? You guys don't. There you go. We have a constitution, right? And what does it ensure everybody? Life, liberty, the pursuit of happiness, right? So if you kill somebody, what are you taking from them? Life. We have declared that we value life somehow, and that everyone has the right to it. So if somebody, takes that away from you, we're saying, no, you can't do that. And the Constitution is sort of governing what's acceptable. And if we write a law that some people think isn't consistent, they're going to bring it to the Supreme Court, and then the Supreme Court ultimately says that is or that is not constitutional. Basically, they're saying, we have this framework, and is this law consistent with that framework? Okay, well, we're doing the same thing in accounting. Okay, we just don't, have the guys, our people don't wear fancy robes and, like the little collars. Okay, but they're doing the same thing. They're saying, here's the law of the land, here's the basic goal of the accounting system. Okay, we have the Constitution of Accounting, and then we make specific rules which sort of have to fit within that law, or within that broad set of principles. We don't always succeed. Sometimes we write rules that are really stupid and don't satisfy the needs, and then a couple of years later they'll get overturned. Or sometimes we'll write rules that sacrifice one thing for another thing. So, we believe in free speech, but you can't yell fire in a crowded theater. Why not? Well, the pros and, you have to weigh off the benefits of free speech with the cost of the fact that people will get trampled on. Okay, so the same thing in accounting. Sometimes we might think we'd like to report one thing, but realistically we can't achieve that, and we have to make some compromise. So that's why we're teaching accounting theory. It's not just, we want to excite you with the conceptual framework, although I think it's exciting, but basically we're trying to help you understand where the rules are coming from. So when you are confronted down the road with a new rule that the FASB decides to implement, you'll understand the basis of conclusion. So they'll explain, well, here's why we're making this rule. It's because we believe we're accomplishing the goals of our framework. Okay, so the conceptual framework is what we call our accounting constitution. Okay, and it's basically the set of objectives, okay, that allow us to have consistent and well thought out rules and procedures. Okay, so we want to have accounting rules that make sense. Who decides what makes sense? Well, let's give a set of goals, and then we'll see whether the rules are helping us to accomplish those goals. Okay, it also gives us some structure. So remember I said, the first class I said, I'm thinking of potentially employing some of you, and I'm going to ask you some information about yourself. If I don't ask you specific questions, you could tell me anything you want. So I want to put some structure on it and have you all answer the same 5 questions. Whereas if I don't say anything and you just speak off the cuff, you may completely be talking in different directions, and it will be very hard for me to compare one person's commentary to another person's commentary. Okay? Also, if the rule setters don't have some basis for writing rules, it will be very dependent on who happens to be sitting on the board at any point in time, right? You could just end up writing any rules you want, and then 5 years later, a different set of people are sitting on the board and they say, well, we don't like those rules and we're going to abandon them. And people will lose confidence in our accounting system if every couple of years we change the rules. Okay, so we need to have sort of something that says, if you're going to sit on this board, you have to believe in the overriding conceptual framework. Okay? The FASB tries to spin it as a positive, but it also could be perceived as a negative. One of the things that the conceptual framework requires is a lot of thought, analysis, and discussion of potentially new rules. And so they're slow. So the accounting standards come out way after the fact. And people sometimes criticize the accountants for being so slow. On the other hand, people criticize regulators for just making a rule that wasn't sufficiently well thought out, and then they have to go and backtrack and fix it. So something like in the case of Sarbanes-Oxley, Congress steps in, they interfere in the rule-setting process, they make a rule, and then now they're still going through the process of cleaning up the mess that they made, because they hadn't really thought it out, but they wanted to make it clear that we're doing something big. Okay. So what are we trying to do? Remember, first class. Why do we provide accounting information? What's the goal? What's the fundamental objective of accounting? Yeah. Okay. An overview. I just want an overview. Can I just tell you in words what my company's about? Wouldn't that be an overview? Okay. So I want to give. What are you going to do with that evidence? As a person who's reading that information. Okay, okay, there we go. So we want to provide information that's useful for decision making. Okay, what information was useful for decision making? Information about future cash flows, right? Amount, uncertainty, timing of future cash flows. So we need to provide financial information that's useful to people that have invested and will invest in the company, whether they're stockholders or creditors. And what kind of information do we think is useful? Information about prospective cash flows. Okay? So that no matter what we do, we should always have as our fundamental goal, we're trying to provide people stuff that matters. So when we talk about should the FASB be regulating disclosures about the location of the CEO's vacation home? Probably not. Okay, that's less relevant. Now, if the CEO is stealing company money and using it to buy vacation homes, well, maybe that would be valuable. Okay, but you don't really need to know every single detail about certain aspects of the company. You only need to know the stuff that's going to change your decision. Okay, so this is sort of the way the FASB has kind of created or tried to create what looks like a little structure of how you want to think about. So we have over everything is our objective: provide relevant financial information. Okay, provide stuff that people think is useful. And how do we define useful? So the first thing that we do when we're defining useful, okay, is we define characteristics of usefulness. So if I asked you, you're buying a used car, what information would you like to know about that car? Mileage, year, has it been in any accidents, the brand of what kind of car it is. Do you really feel strongly about whether the seats are gray or green leather? Maybe if it's a brand new car, you have some preferences, but is that like the main driver of value? No, it sort of like falls pretty low down. Okay, do you care if it's manual or automatic? Well, if you don't know how to drive a stick, you really care about that a lot, right? So there are certain characteristics that matter a lot, and other characteristics maybe which don't matter quite as much. So they've decided there are two characteristics which define whether information is useful or not. Okay? The first is relevance, okay, which means if you had the information, you would actually use it in making the decision. So in my example of the color of the leather seats, like I don't really think that it would make a difference very much in the pricing of a 10-year-old used car whether the seats were gray or green. Okay? However, if I told you how many miles it had, that would be very important to you. The second thing is it has to be a faithful representation, which means what I'm telling you is or the thing that I'm trying to tell you about, I'm actually effectively communicating that with the information. So let's say you say, I really want to know the mileage of this car. The problem is the odometer broke 8 years ago, and I've been driving it for 8 years with a broken odometer, okay? So now I'm going to you say, I really care about the mileage, and I'm like, sure, I'll tell you the mileage. It's 23,000 miles. Is that helpful? Why not? It's okay. So not only is it something that you would want to know about, it's something that you actually can measure with reasonable confidence, and it's representing what it claims to represent. So yes, it's true. If you look at my mileage, it will I'm not lying to you. It says 23,000 miles in the car. But that has nothing to do with the actual mileage, so it's not a good representation. It's not not representationally faithful of the actual number of miles driven. Okay? So yes, you're answering the question, what's your odometer reading, but you're not answering the question, how many miles have you driven? Okay? So how do we sort of then further define what makes something relevant or what makes something representationally faithful? And so relevance is, why would I want to use this information? Well, because it can help me predict the future, and it is confirming my beliefs about the past. So I had some predictions in the past, or I thought this company was going to do well or not well, and then the information is saying, yes, indeed, they did well, they didn't do well. Why does confirmatory value help? Because that's telling me something about my ability to predict using the information that I had in the last period. So I used last period's information to predict the future, and then you're telling me, yeah, you were right. So then I can keep using the same model. If I find out I was completely wrong, then I have to rethink my model, okay? Or I have to rethink the information that I used as an input. Also, how well is it, how capable is this of doing a good job predicting, even if I had the perfect model? Okay, so those are two things that make something relevant. I can use it, I want to use it, and it helps me both predicting and confirming my ability to predict in the past. And then something is a faithful representation if it's complete, so all the information I need is there. So in the mileage example, not only am I telling you how many miles I have, but I'm also telling you, and oh, by the way, my odometer broke 8 years ago. That would be more helpful than just knowing the 23,000 miles. It's neutral, so it's not favoring one party or another. So in the case of the mileage, if my odometer would work either all the time or none of the time, okay, and I knew which one, I could kind of estimate more accurately what the mileage was, okay? And as long as I gave you, I said, okay, well, this is what the reading is, but that's because of this, and I'm going to give you a better estimate, as long as I was being fair. What's the problem with the fair estimate? Well, I always have incentives to, tell you less than it really is. So neutrality is saying the information is created in such a way that one party cannot manipulate it to their benefit. Okay? You can always manipulate information to some extent, so you have to understand, this is a perfect world. We don't always get neutrality. We kind of approach neutrality. And then it's free from material error, so we don't have any enormous glaring errors. Does it mean it's perfect? Does it mean it's right? No, it just means we are using the information that we have to the best of our ability to give you the best prediction or the best estimate that we currently can. Okay, and then we further want to enhance this by comparability, which means if two companies give you information, you can look at both of them and say, oh, Company A and Company B, they both have earnings of $1 per share. That's a meaningful comparison. Whereas if one company uses one way of calculating earnings and another company uses a completely different way, then you can't compare them. So let's say one odometer is in miles, the other one's in kilometers. Now you could argue, I'm not stupid, I can actually do the multiplication and figure out, oh, okay, well, kilometers, points, do something. That's fine, but if you don't know, if I just tell you, here's the mileage, and I don't tell you what units it's in, those things are not comparable. On the other hand, if I switch back and forth from year to year, I kind of constantly keep changing the rules on you. It's very hard to compare from year to year. So consistency means, or comparability means I can compare two companies with each other, and I can compare a company over time. And those things are meaningful comparisons. And then I can verify it. So if a bunch of you were out there measuring it, you would all agree on the same number. Okay, it's not that the number is right, but at least a bunch of smart, experienced auditors would come up with the same conclusion. Okay, timely. Is it useful? So let's say you need to buy a car, and you ask all the potential people who are selling you the car for some information about the car. And you make your decision on, so you have 10 potential sellers, and you say, please email me the specs of your car. And then you make your decision on Thursday, January 26th. And then one of those potential sellers sends you the information on the 27th. You've already bought your car on the 26th. Would you say that the information is relevant for that 10th car? Well, yeah. I mean, it would change your. It helps you value that car, but is it relevant in making decisions? No, you've already made your decision, right? So timeliness means if you don't get the information when you need it, it stops becoming relevant. So yes, if you had it, you would like it, but you need it in a reasonable amount of time. And understandability means we don't just throw so much stuff at you that you can't possibly decipher what we're telling you. We try and present the information in a way that you can understand, that it's clear, and that is not a deliberate form of obfuscation. Okay, so those are the goals, the broad characteristics. Now, I've explained this all sort of in a lot of slides, but you don't need to go through these individual ones. Okay, so then we have, well, how are we going to accomplish it? So what are we going to tell you? Well, we're going to tell you about the assets, the liabilities, and the equity of the firm. Remember, we also said you want to know how much money how much the company has, how much the company owes, and who owns the company, right? So liabilities, owner's equity, where the company stands at any point in time. Those are things that are relevant. So this is our goal. How are we going to do it? Well, we're going to tell you information about assets, liability, owner's equity. We're going to tell you information about revenues, expenses, gains, and losses. And we're going to tell you information about dividends, distributions to owners, stock buybacks, things like that. Okay, those are the things that we want to know about. Now, where are we going to tell you that stuff? In our financial statement. Am I done? Well, not really. The problem is, I have all these goals, I have all these characteristics I want, and now it comes down to, how do I decide what to do next? Okay? And so I have to figure out, how do I measure stuff? Remember the very first day we were talking about, we had a car, we gave a bunch of specifications, and I said, how much is that worth? And no one could really agree. And we argued that, well, it's worth different things to different people for different reasons. So we have some sort of rules that we need to impose on financial reporting so that we can satisfy our goals. Okay, the first one is, we talked about recognition. When do you put a transaction down? What were the three criteria in order to have something be a transaction? Remember, did it count if I sold something within my firm? So what was rule there. It needs to be with an external party. Can I just write a contract and then record a huge amount of revenue because at some point in the future I'm going to get that money? It has to be partially executed. What was the third thing? Okay, so I have to be able to measure it. I can't just sort of be completely out in. So here, not only do I need those three things, but I also need to know that people care about the information. So I have to be able to measure it. It has to meet the conditions of a transaction, and it has to be relevant. Okay, so I wouldn't include it if the information is not capable of making a difference. What does it mean to be reliable? It means I can measure it reasonably with sufficient reliability, and it meets the definition, meaning it's with an external party, and it's possibly partially executed. Okay, so now we get to the fun. I don't know. Fun. I think it's fun. We get to the good stuff. Okay, so what do we need to assume about a company? So let's suppose you own some shares of stock in a company. That company goes bankrupt. When you look at this company and you look at its balance sheet, does it have on its list of assets all of your personal assets, like your house, your car, your bank account? No, why not? Go ahead. What do you mean I can't? I can. I could just say, okay, the assets of the firm are equal to everything the firm has bought plus all of the assets of the owners. Why don't I do that? Okay, so there's a rule. Okay, what's the rule? Okay, so there's some line between personal property and firm property. Yep. Okay, so corporations make it easier because legally there's a distinction between ownership of the firm and limited liability. But even if you weren't, if you were just trying to keep the accounting books for a sole proprietorship, you would still want to separate the books of, say, your little small mom and pop grocery store with your own personal house. And the reason we do that is because we make this assumption, okay, and it's exactly an assumption. It's not truth. This is how we've decided to do it, is we have what's called the economic entity assumption, which says a firm is an entity unto itself, entirely separate from its owners. The owners contribute, and in exchange they get common stock. And that is the extent to which we have the owner's value showing up on our financial statements. The owners, the additional assets of the owners are not part of the firm. It's not a legal issue, it's an accounting convention, because legally, if you're in a partnership, you could technically sue the partner for everything they're worth, okay? But nonetheless, when you think about the books of the accounting firm, or of the firm itself, you just want to know, what is this firm operating with? What are the assets of the firm? And therefore, what is this company capable of generating given the assets it's employing? Okay, so the economic entity says the firm and its owners are separate. And we can distinguish between what are assets of the firm and what are assets of individual owners, and those do not show up together. Okay. Now let's suppose we're thinking about a company. Let's talk about a company that makes, or just like a small company that sells hamburgers. Okay, so they buy a grill. Now, the minute they buy the grill, they go to, I don't know, some fancy kitchen supply store, and they spend $15,000 on this grill. They install it in their store, and it's ready to go. Now, a few days later, they're rethinking and saying, you know, should I stick with this business or not? Well, do you think if they decided not to stick with the business and they tried to resell that grill, they would be able to sell it for what they originally paid for it? Now, maybe there's some return policy, but assuming there isn't, they're probably going to take a hit on that. So should the company revalue the grill at what it can sell it for today? So when I look at a company, should its assets be recorded at how much they would be worth if I sold them? Why not? Okay, what if I know for sure? There is a list price. The company itself says, here's a contract, I will buy it back if you want. I'll buy it back at $12,000. Yeah. Okay, it's true that I tend to follow the historical cost convention, but why do I follow the historical cost convention? Okay, but what I could sell it for is what I could sell it for. What if I sell it at a loss? I mean, it's not that I don't. So why are you pushing historical costs just because you learned about it in accounting? Like, why is it a good thing? So the point here is, you're not supposed to just say, I use historical costs because that's what the accountants told me. There's some reason we use historical costs. What is it? Yep. Okay, so we don't like the idea that prices should be fluctuating, so we think it's not relevant to give people information that's all over the place. Is that? Okay, what else? I put a box around it. That's a hint. What do you think going concern means? Going concern means the way we treat a company is as if it is going to continue into the foreseeable future. If a company, so let's talk about our little hamburger shop. If I assume they are going to continue into the foreseeable future, is it relevant to know how much they could sell the grill for? And are they going to be selling the grill, or are they going to be selling hamburgers that come off the grill? Hamburgers that, so I don't really care what the value of the grill is. It's not relevant because, so when you think about why do we use historical cost, it's not just because it's easy, it's not just because it's a number that we all agree upon, it's because historical cost is as relevant as anything else if we're assuming the company is going to continue into perpetuity. Yes. I can handle it. Go for it.
So you're selling hamburgers.
Yep.
What's a hamburger? $3.
Okay.
$95 now. Value to that, still you're manufacturing yourself hamburgers. Still cost, not selling hamburgers $5 cost. You can't just say, okay, my say, I'm going to just value work.
No, but you're not selling it. Okay. So, if you bought the ground beef at $3 a pound, and then the next day there's a shock, all cattle everywhere have dropped dead, so now it costs so much money to buy ground beef. What do you have that your competitors don't? You have a cost advantage. You can sell your burgers for the same price as they can, but it costs you only $3 a pound and it costs them $5 a pound. You're going to make a lot more money. So you're going to end up pocketing more profit. Okay? It has, well, but the reason I'm making money is because I'm going on as a business, not because I'm going to just go and turn around and sell the ground beef uncooked to some of my competitors, right? So the idea is that I'm not going to use the underlying ground beef to resell, although, whatever. I'm going to actually sell the burgers and earn a higher profit than somebody who has to pay more money for them. Or I could charge a lower cost and basically steal all their business and then become, the successful one in the industry. So it is as an operating activity, not as a resale. Okay. So these are the assumptions which are going to help us make these other decisions, okay? It's not, we think about a company as being a going concern, and then that is why we're going to apply historical cost. Periodicity. So remember we said we need stuff to come out in time to make a decision. So what happens if a company says, well, but we're not finished yet. We're still operating. We haven't finished all our contracts. We have all these things outstanding, and we want to tell people how good we are, but only after the contracts have been executed. Well, accounting says, too bad. Okay, we are going to assume, for accounting purposes, you can split up the life of a firm into discrete chunks, and you can report sensibly in those time periods. So when you think about a company reporting, you say, okay, well, I don't know when this contract's going to be executed or not, but just come December 31st, we are going to close our books and we're going to tell you how we did thus far. So there is some requirement which says if information is to be relevant, it has to be timely. The only way it can be timely is if we force you to report at specific intervals. Okay. Then the last thing, and this is kind of obvious maybe, but maybe it's not as you might not have realized this was an assumption. When you look at a company's balance sheet, does it just list all of its assets like, okay, we have 6 houses and 3 cars and 27 this? No. It actually just says buildings, and it gives you a number. And what that means is we can measure everything in dollars and cents. Okay, it doesn't have to be dollars, it can be in euros. But everything can be measured with a value as opposed to trying to aggregate together just unlike things. So we can put a number on things and we can put them together. So we have one building over here, one building over there. We don't just call that 2 buildings. We can call it building and give it a value. Okay, so that what monetary unit is basically saying is we can monetize everything. Okay. Now, we also go a little bit further and we say we can monetize everything in one currency. So even if something is located somewhere else, which has a different currency, we can record it under one set of rules. Because we don't want to have cash balance and then tell them, okay, well, we have $8,000 in U.S. dollars, we have 20,000 yen, and we have 14,000 euros. I mean, that's you just want one number, right? And so we can do that. Now, how do we accomplish that? Well, we already talked about historical cost. And what historical cost, the advantage of historical cost is you have no problems measuring it. So in terms of representational faithfulness, it is neutral. It doesn't bias one part. It's not in favor of one party or another. Nobody gets to decide what their historical cost is. It is known, okay? It is complete in that, all the information about historical cost is easily evidenced with an invoice, okay? And it's free from error. So if you actually report what you paid, there's no mistake. What's the problem with historical cost? So it satisfies a lot of these, it makes sense if we're a going concern. It is representationally faithful. What's the negative? What's the downside of historical cost? Yeah. Okay, so it sort of doesn't necessarily always succeed in terms of relevance. So let's say I bought a piece of land, and then the value of land in that area skyrocketed. If you look at what I paid for it, and you're trying to decide, should I encourage this company to sell this land or not, wouldn't I actually want to know what it's worth, not what I paid for it? So, although historical cost is the benchmark for many, many accounting assets, it is not the only thing that we use. There are certain assets which we measure differently, particularly those for which we have a good market value, okay? And particularly those where there's credible evidence that we're likely to actually get the market value. So if the going concern as a firm is met, but we actually do plan on selling this asset in the near term, then we may change its value based on market prices. Okay. Okay, so in the case of, say, financial assets, like we own shares of stock, and we plan on selling them sometime in the near future, well, then it might make some sense to value those at the market rather than at the historical cost. So if I bought shares of Apple in 1982, wouldn't I really rather know what they're worth right now than what they were worth in 1982? Wouldn't that be some more relevant if I'm an investor thinking about investing in this company and I want to know what their investment portfolio looks like? The realization principle is what we said. You can only realize, okay, so when we talk about realization, that means how much we can record regardless of the cash issue. So if we have a transaction where we sell on credit, it's not that I need the cash, it's that I need either the cash or some reasonable belief that I will get the cash. So cash is not driving my accounting system, but rather when it's realized or realizable. Okay, so this is sort of the accrual accounting component. Matching says, and we've already talked about this, you want to have the expenses in the same period as the revenues which they generate, to the extent possible, but sometimes we just match expenses in the period in which they're incurred. And then full disclosure, this is bogus, but basically it says you should tell people extra stuff if the numbers aren't clear. But what does it mean to have full disclosure? Does it mean you give them 50 pages? Does it mean you give them 1 page? So this is very ambiguous what this actually means. Okay? So let's try and do some problems based on the last thing I just want to mention is there's also just some practical constraints. So yeah, we have all these lofty goals, we have all these ambitions on what we want accounting to look like, and at some point you say, well, let's be serious, there are some points at which we have to just give up on our goals. And when do we give up on our goals? Well, if the costs don't outweigh the benefits. So if you say, I would really like to know the value of this asset, okay, and the company could go out and measure it, they could pay 16, you say, they could pay 5 different people to measure it, and they all come up with wildly different estimates. And they say, well, we don't feel really comfortable with those, so we could pay another 5 people and see what they come up with. At some point, if the whole asset is only worth $10 and you've asked 15 people and you've paid them each $10 to measure the asset, was that worth it? Would anyone actually care? So there has to be a benefit of knowing the information that exceeds the cost of providing it. Now, those costs could be different from actual tangible costs. It could be proprietary costs. So if I tell you this information, you're going to know some secrets about my firm, which I don't want you as my competitor to know. And so I have to kind of weigh off the fact that companies shouldn't be forced to tell you everything, because then they might lose their competitive advantage. And if a company knows they're required to open their, so wouldn't you like to know what's in Coke if you're Pepsi? Yeah, I'd like to know that. You might even like to know it if you're a regular investor. Okay, but the fact is, if they start, we require you to share that information, that doesn't really seem fair, because the cost to Coke of providing it would certainly not outweigh the benefits of you as an investor knowing how much sugar is actually in Coke. Okay. Now, materiality. If the numbers are so small or too small to make a difference, then we can potentially claim that they wouldn't really be relevant in decision making. So if I round to the nearest 1,000 and I'm a multi-billion-dollar firm, do you really care what's in the tens place of my financial information? Probably not. Okay, but that's a bit of a slippery slope, and companies have gotten into trouble with that. So let's suppose we're talking about a huge company, and they have a computer on the desk of every single one of their employees. So the company has, overall assets that are worth, so a computer on the desk of all of its, 100,000 employees, let's say a $3,000 computer, you could say that could be pretty significant, right? But does one computer matter? Right, one computer is $3,000 compared to the, what, $3 billion worth of computer equipment that they might have, or 300 million, whatever I said. So 3,000 versus 300 million seems pretty irrelevant. And you might say, well, forget it. But if you forget every single one of those computers, because each one is immaterial, then you wouldn't have any property, plant, and equipment. So you're not supposed to just, say, oh, it's small, so I ignore it. It's just you don't want to get to the point where the only thing you care about is the nitty-gritty at the expense of sort of the big picture. Okay? And the last thing is you want to make sure you've adequately taken into account the risk. So yeah, we use historical cost, but if there's some reason that historical cost is an overstatement of our position, we do need to warn people about those potential risks. We're not supposed to understate deliberately, but we do need to at least pay attention to the fact that you kind of need to warn people about the uncertainty aspect of things. Okay, so now we're going to try the clicker. See how this works. Of course, now my clicker thing went away, and I have to find it again. Okay, so here's the clicker thing. All right, so here we go. Let's try it. So everyone has their clicker, right? Now, which constraint would allow a company to record the purchase of a $120 printer as an expense? So you buy the printer and you just write printing expense cash for $120 rather than printer as an asset and cash for $120. Is it cost effectiveness, so the cost of that transaction or cost of reporting that transaction don't outweigh the benefits? Or is it materiality? Or is it conservatism? Which of those three would you say? So type A, B, or C. I don't think it's working. Okay, are you typing? All right, there we go. We're getting responses. Okay, everyone responded? All right. Oops. That didn't work. That was a fail. I don't know how to get their answers. Try again. Respond. All right, here we go. There we go. Okay. So, some of you are taking back yours. Okay. So most people correctly thought that the answer was materiality, which is basically we are saying that if the only printer this company buys is $120, and this is a big company, okay, recording it as an expense immediately will not materially affect decision making. Okay, you're not going to buy this company just because it has an extra $120 printer as one of its assets, nor are you going to get rid of this company just because this year its expenses were $120, because the argument would be this is too immaterial to actually make a difference in decision making. So we don't bother with it. Okay. Now, what if the chairman of the FASB makes the comment that there must be public confidence that the members, or that the standard setting system is credible, that the selection of board members is based on merit and not the influence of special interests. So the FASB board members are chosen, and he's talking about how the FASB board members should be chosen, and they need to be chosen based on merit, not the influence of special interests. So what is he trying to say? That if you choose people based on merit, not special interests, they will write standards which are more likely to be complete, neutral, or free from error? Respond. All right, let's see. All right, great. So the idea of having people that are deserving rather than chosen by one party or another is that they're neutral. Okay, they're not going to just vote for a standard because it helps their buddies. They're going to vote for a standard because it's the right thing, it's the best decision. What do you think of the clickers? A, if you like the clickers. B, if you don't like it. All right, I'll give you the clicker. I'll give you the clicker assessment afterwards. After we answer these 4 questions, because I'm totally not sold on this yet. Okay, so we've got a company which has changed its revenue recognition policy. So it used to follow one method, and now it follows another method. What is violated, or what characteristic is jeopardized? Has it made financial statements that are somehow less verifiable? Are they less consistent? Or are they less timely? We only have 45 people in this class, so if we start getting like responses. All right, great. So, and by the way, I won't always pick B. So, I mean, I see it's that way here, but I won't always do that. It's like B. Okay. So yeah. So what are we accomplishing here? We're trying to basically say, well, go away. Okay. If we use the same method from year to year, you can compare the company's performance one year with the next. But if you don't, it's like comparing apples and oranges, and you can't actually decide, well, is $1 per share good this year compared to $1.50 last year if we've completely changed the system of measurement. Okay, so we need consistency, and verifiability is just saying that different measurers would come up with the same answer. Well, yeah, if you say measure it using this rule, measure it using that rule, they still might come up with the same answer, but it wouldn't be it wouldn't necessarily be consistent. Okay, last one. National Bancorp files quarterly and annual financial statements with the SEC, and which characteristic is relevant to the timing of these filings? Okay, so hang on one sec. We gotta start recording. Okay. No, that didn't work. All right, there we go. Okay, so, yep, see, I didn't always think it. Okay. So this is saying, look, even though a company's activities may span more than 3 months or more than 1 year, we are required to report quarterly and annually because information is only valuable if it's timely. It's only timely if it comes before we make decisions, not after the fact. Okay? All right, last thing. So, genuinely, do you like having these clickers? Okay, hold on. A for yes, B for no. But that means, of course, I'll have to come up with some more. All right. Oh, good. Okay, you like the clickers. All right. So, if nothing else, it makes me work harder. Okay. So I will collect them at the end of today, but then I will make sure I have 100, enough for this class and next class. Oh, you're not. Go ahead. Sorry. Oh, okay. So let's just finish up with a problem, okay, which maybe I'll try and use the clickers for if I'm not too stupid to figure out how to do it. Okay, so here we go. We've got, during the year, the company purchases equipment by issuing common stock. So basically, instead of its owners contributing cash and then purchasing equipment, what it does is it says to one of its suppliers, hey, we don't have any cash right now, but if you give us some equipment, we'll give you shares in our company, and then you will own shares of our stock, and as soon as we start making money, that'll pay off for you. So that's the first thing that happened. Then the stock had a par value of $135,000 and a market value of $450,000. Okay? The fair value of the equipment, there was no way to determine what the value of the equipment is. So all I know is that if I sold the stock in the open market, I would be able to sell the stock for $450,000. Okay? Par value is just some fictitious number that the company created at the beginning of time, and so it doesn't have a huge amount of importance. The company recorded this transaction as equipment $135,000, common stock $135,000. Is that right? Yes? Okay, why? Why is that right? What principle is guiding your answer? Historical cost. Well, okay. Anyone disagree? Yeah, what do you think? Okay. 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 So, is your answer consistent with historical cost? It is. Okay. So here's the thing. This is deliberately this is to remind you what historical cost means. Historical cost doesn't mean something irrelevant that's just, the point of historical cost is to say, on the date of the transaction, when we make an exchange, I'm paying you something, you're paying me something. What is the best evidence of what I'm paying you? Well, I'm paying you shares of my stock, which I know I could have sold in the open market for $450. Just because it's the market value doesn't mean it's not the historical cost. Okay, if I were to first sell the shares, I would get $450,000, and then I'd have to give you that money and buy the equipment. Okay, $135,000. This has nothing to do with the cost to me. Okay, as a firm, I am giving them a bunch of shares of my stock. They own pieces of my stock now. They own a chunk of my firm, and they gave me equipment. What is the value of the equipment? Well, they didn't have a list price for that. So the only thing I could say, the fair exchange would be, I gave them shares worth $450. They gave me equipment worth $450. Okay, so that's the way. Historical cost does not mean not market. On the date of sale, historical cost and market are the same thing. It's only afterwards that historical cost stays still and market value changes. Well, it doesn't matter what it's worth in 2 months. So now, let's say 2 months from now, the stock value in the market is $480. You wouldn't then write up the equipment to $480. So historical cost means you leave it at what you paid for it. But what you paid for it doesn't necessarily have to be some ridiculously low value that has nothing to do with the current arm's length transaction. Okay. During the year, the company sold equipment for $285,000, recognizing a gain of $69. Because they needed new equipment in the near future, they decided to defer the gain and advertise it over the life of the new equipment purchase. Is that the right thing to do? Should we? If you think yes, why? What principle or so now when I ask you something, you can't just it's my gut reaction or I think I remember it from Accounting 1, right? Tell me what we just talked about today that would say yes on this or no. Should you defer gains? What would be a reason to not recognize a gain? Okay, forget about taxes. I can't save on those. Would it be conservative? Right? If I tell you I have a gain, maybe I won't. Is it conservative? Is that the right? Should I say this is okay because it's conservative? Well, what do you think? Should I let's say I sell equipment. What should I do? I get rid of equipment. I get cash. Now, they're suggesting that I would record a gain or not record a gain. What do you think I should do? Record it or not record it? Is this the right journal entry? Yeah. Why? When do you recognize a gain? When you sell the asset. Do you defer it just because that makes your income look lower? Are you supposed to be conservative just for the sake of being conservative? No, you're conservative just to express the risks of the firm. There's no risk left here. I've sold this asset. Okay, I can't write it up to $285 until I sell it, but once I sell it, there's no excuse for deferring the gain. Okay, so conservatism doesn't say understate, it just says don't overstate. Okay, for all of these, but we'll do 2 more. Okay, an order for $61,500 was received for products that were on hand, and the order was shipped on January 9th. the company made on January 9, 2011, the company made the following entry in 2010, accounts receivable of 61.5, sales 61.5. Can you do that? Why not? Okay, it hasn't been executed, so you can't recognize this transaction until it's been executed. Right? So it doesn't meet the conditions of recognize or realizability, because you can't realize that accounts receivable until you actually send them the product. Okay, a firm purchased some materials for $120,000. The amount was entered into the materials account on 12/31/2011. The materials would have cost $141, think hamburger example. So they record an increase in the value of the inventory and a gain. Can you do that? Why not? Okay, so historical cost. Why historical cost? Okay, it costs you 120. Why, in this case, are we recording 120 rather than 141? Why is it irrelevant? Wouldn't I like to know that it... Okay, but what if I am going to sell it? What if it's a bunch of T-shirts that are just now really hot and selling like wild cakes, whatever, wildfire, hot cakes, I don't know. So the reason here is I can't recognize a gain. Why not? Because I haven't actually sold the asset. Yes, I will sell it. Okay, it's not going concern that's preventing me from recording this. It's the fact that a transaction has not occurred that allows me to recognize the gain. Because conservatism says, well, you may not get that gain. What if the T-shirts, what if somebody says, oh, well, actually they make you really sweat and they get really bad press and then nobody wants to buy them after all. Okay, so then they could only end up selling for $100,000, in which case you can't recognize the gain until it's a certain locked in, the transaction has occurred.